There is this blunt, uh, honestly almost offensive truth on Wall Street.
Oh, I think I know where you're going with this.
Right. It's that half the people working there, I mean, they have an IQ over 160. They are certified geniuses.
Yeah, literally building algorithmic trading models in their sleep.
Exactly. And yet, they still lose money.
It is the ultimate humbling reality of the markets, really. Raw computational intelligence, it just doesn't automatically translate to positive returns.
Because human beings are notoriously terrible at operating in pure uncertainty.
Right. We hate it.
So you have to ask yourself, why do the smartest people in the room keep getting it wrong? Well, it's because they are obsessively trying to predict the future instead of just figuring out where they currently are.
Yeah, they want to forecast the next macroeconomic black swan.
Which is practically impossible.
It's totally impossible. They're trying to gaze into a crystal ball to see what the world looks like, say, 3 years from now, when they should really just be looking at a map to understand exactly where they're standing today.
Well, welcome to today's deep dive. We are exploring a fascinating framework today that completely flips how we should analyze the markets. We're drawing from a brilliant article published on April 17th, 2026.
Yeah, from the Substack, Equity Decoded by Spirit.
Right. It's titled, The Clock That Most Investors Can't Read.
And this piece is just a phenomenal synthesis of market theory. It leans really heavily on the philosophy of billionaire investor Howard Marks.
Who is a legend in this space.
Absolute legend. And his entire operating system is built on that exact premise. You cannot know the future, but you absolutely must know where you are in the cycle because, the cycle dictates everything.
So our mission for you today is pretty straightforward. We want to help you stop buying at the top of the market when everyone feels great and start finding what the industry calls multi-baggers.
Those are those rare investments that multiply your initial capital 5, 10, or even 20 times over.
Okay, let's unpack this.
Mm.
Because to do that, you have to decode the 6 stages of a hidden market clock.
Visualizing it as a clock is incredibly helpful here. Before anyone can spot the next big sector rotation, you have to accept that the market is not a random walk.
It's not just bouncing around based on whatever the news cycle is today.
Exactly. It operates like a ticking analog clock, tethered firmly to the underlying business cycle, and it moves through 6 very distinct sequential stages.
I want to break down those stages because understanding them is basically the key to knowing which sectors are catching a tailwind. Let's start at stage 1.
So stage 1 is the contraction phase. The economy is visibly slowing down. Interest rates are dropping because central banks are, desperately trying to stimulate growth, and fear is absolutely pervasive.
Like panic selling is the norm.
Right. Everyone is panicking. In this environment, safe government bonds are the massive winners. Investors want locked-in yield because they are terrified of equities, so stocks just get completely hammered.
But logically, if asset prices are getting destroyed and yields are dropping, that creates a vacuum, right? The smart money isn't going to sit in cash forever.
No, they're going to start looking for the absolute cheapest assets with the most leverage to an eventual recovery.
Which pushes us right into stage 2.
Yeah. Stage 2 is the bottom. This is honestly the secret starting line of the entire wealth creation process.
Even though the broader economy still looks objectively terrible?
Oh, it looks awful. Unemployment might be peaking, corporate earnings calls are deeply pessimistic, but the institutional players, they quietly start accumulating financials and consumer discretionary stocks.
They're doing this months before the recession is officially declared over.
Precisely, because they know rate cuts eventually stimulate lending and spending.
And if that quiet buying happens, the momentum shifts, forcing the market into stage 3, which is the early expansion.
Right. The data slowly begins to validate that early optimism. Commodities wake up from their slumber. This is when technology and industrials really start leading the charge.
And the careful observers see the shift in corporate spending. But the retail crowd, they are still way too traumatized from the stage 1 bloodbath to even participate.
Yeah, they're just sitting on the sidelines watching the market climb a wall of worry. And then comes stage 4, full expansion.
Oh boy.
This is the dangerous, everyone's a genius phase.
I know that feeling intimately. You log into your brokerage account and literally everything is green.
Yeah.
Your neighbors are giving you stock tips at a barbecue.
It feels incredibly validating, but structurally, it is a total trap. The economy is running so hot that inflation is picking up. Central banks are forced to start hiking interest rates to cool things down.
Which means those safe bonds from stage one start to suffer.
Exactly. Energy and materials are the hottest sectors here because demand is just outstripping supply everywhere.
So that warm, comfortable feeling of collective optimism is actually your blaring warning sign that we are transitioning to stage 5, the
Yeah.
pink.
The high interest rates from stage 4, they finally start choking corporate profit margins, meaning the stock market peaks and rolls over before the actual economy does.
Because the stock market is a discounting mechanism.
Exactly. It senses the coming margin compression. Energy and materials might have a last speculative gasp, but overall earnings growth is slowing down.
But the disconnect is that consumer optimism is usually at maximum volume during stage 5.
Which is a massive red flag. And finally, the clock strikes stage 6, deterioration.
The denial phase. People holding onto their tech stocks just praying for a rebound that isn't coming.
Right, the crowd absolutely refuses to accept the party is over. Broad equities fall and commodities roll over hard as industrial demand evaporates.
So what's safe here?
The only safe havens left are the defensive sectors. Things people have to buy regardless of whether they have a job or not. Healthcare, utilities, consumer staples.
So hearing the mechanics of this, the most crucial insight seems to be about the lag time. The stock market is essentially a leading indicator looking, 6 to 9 months ahead of the real economy?
Yeah, about 6 to 9 months. You're supposed to rotate your portfolio during the recession when the headlines are absolutely terrifying.
You have to buy the dread and sell the euphoria, which violates every human survival instinct.
Completely.
It's like surfing. You can't catch the wave if you wait until it's already crashing on the beach. You have to paddle out when the water is perfectly flat, boring, and maybe even a little cold, just anticipating where the swell is going to build.
That is a perfect analogy.
But hold on, let me push back on this timeline. If the stock market really leads the economy by up to 9 months, does that mean when we see fantastic economic news on TV like GDP surging, unemployment at record lows, that is actually a trap?
What's fascinating here is how fundamentally retail investors misinterpret positive macroeconomic data. They see a blowout GDP print on the news and think, it's a massive buy signal.
Right.
But by the time that data is codified, edited, and broadcasted on mainstream television, the institutional money has already priced it in. That glowing news report is a late-stage confirmation of what happened over the last year, not an early warning system for the next one.
So buying on good news is essentially providing exit liquidity for the people who bought the bad news.
Unfortunately, yes.
Which brings us to a glaring contradiction. If this 6-stage clock is so predictable, and everyone on Wall Street knows it exists, why does almost everyone miss the timing?
It comes down to a psychological trap deeply rooted in John Nash's game theory.
Game theory. Okay, how so?
Well, you have to remember the ecosystem we are dealing with. Every fund manager reads the same research. They all read the Howard Marks memos. They all know that when the Fed or the RBI hints at a dovish pivot to cut rates, banking and consumer stocks are going to catch a bid.
And because they all know the optimal, quote-unquote, smart move, they completely neutralize the advantage by trying to make it at the exact same millisecond.
Right. The herd mentality is weaponized. The moment the macro hint is dropped, massive algorithms and discretionary funds rush into the same sector simultaneously.
So by the time the average investor spots that sector break out on their trading screen,
The structural rotation already happened 3 to 6 months prior.
wow. And the average investor falls into the danger of the familiar. They buy what is already working because it feels psychologically safe.
Exactly. If tech is up 20% for the quarter, they want in on tech.
But stepping into a hot sector is stepping into a trade that is rapidly approaching its expiration date.
You're showing up for the last dance, assuming the music is going to play all night.
Here's where it gets really interesting, though. Because it sounds like you're saying we have to show up to the party before the host has even built the venue.
Basically, yeah.
We have to buy when the data looks genuinely awful. But isn't there a massive risk of just stepping in front of a freight train thinking it's running out of gas? Like, how do you know you are early to a brilliant thesis and not just catastrophically wrong about a dying industry, catching a falling knife, so to speak?
This raises an important question, and it actually targets the core thesis of the equity decoded piece. In 2026, information asymmetry is largely dead.
Everyone has the same data in their pocket.
Right. The real edge in modern investing is not informational, it is behavioral. It is having the cognitive discipline to act when the mood around a sector is viscerally depressing. The most lucrative entry points will always feel terrible.
Because if the setup felt comfortable and obvious, the premium would already be priced in.
Exactly. The price of generating alpha is that knot in your stomach telling you that you are entirely alone in your thesis.
I get the philosophy, but, human brains are biologically hardwired to seek safety in the herd. If our own amygdala is tricking us into waiting for comfortable late-stage news, we can't just rely on raw willpower. We need a way to bypass our emotions entirely.
You need a cold, quantitative dashboard. You cannot rely on your gut when your gut is screaming at you to liquidate everything. The source outlines very specific instruments that professionals use to hear the clock ticking beneath the noise of the news cycle.
Okay, let's build that dashboard right now, connecting these tools logically. If we want to catch a sector rotating from stage 1 to stage 2, the first thing we need to see is where the capital is actually flowing, regardless of the narrative. That starts with relative rotation graphs, or RRGs.
RRGs are phenomenal for stripping away the emotion of absolute price. They plot every market sector on a 4-quadrant map: leading, weakening, lagging, and improving.
And where's the sweet spot?
The mathematical magic happens when you track a sector crossing the boundary from lagging into improving. The sector is usually still down for the year, and the news is still terrible, but the relative momentum against the broader market is shifting upward.
That is the footprint of early institutional accumulation.
Exactly.
So the RRG tells us the big money is quietly moving into a battered sector. But how do we know if the real economy is going to support that move? We have to look at the consumer's mindset, which brings us to the discretionary versus staples ratio.
This is the ultimate behavioral metric of the broader economy. It measures the performance of wants against needs.
Wants versus needs.
Right. When the ratio is rising, meaning consumer discretionary stocks like luxury goods, travel, and restaurants are outperforming consumer staples like toothpaste and basic groceries, it signals deep-seated consumer confidence.
But when that ratio rolls over and people bunker down into necessities, the cycle is turning.
Yes. It flashed a massive warning signal before the 2007 crash, and it flashed green in early 2009, months before the broader market bottomed.
Okay, so the capital is rotating on the RRG, and the consumer is showing resilience on the staples ratio. But consumers buy things that factories have to actually build. We need to measure the industrial engine.
Which is where the ISM manufacturing PMI comes in.
Right. Usually people just look to see if this number is above 50 for growth or below 50 for contraction.
And looking at the absolute number is a rookie mistake. The entire value of the PMI is in its directionality.
How do you mean?
If the PMI is sitting at 48, meaning the manufacturing sector is actively shrinking and factories are laying people off, but it climbs to 49 and then 50, that upward trajectory is the massive early signal. It means the destocking cycle is over.
Ah, so it's about the shift.
Exactly. India's PMI stayed persistently high for most of 2024 and 2025, which provided a purely data-backed green light for their massive infrastructure boom, completely independent of whatever the political narrative was at the time.
But factories need credit to build those goods. They need to borrow money. Which brings us to the macro credit environment, the yield curve.
Right. The relationship between short-term and long-term interest rates dictates the flow of credit. If the curve inverts, meaning short-term rates are higher than long-term rates, you run to the defensive stage 6 sectors.
Because banking relies on the spread.
Exactly. The mechanism here is simple. Banks borrow money at short-term rates and lend it out at long-term rates. When the curve inverts, their net interest margin collapses. It becomes unprofitable to lend, so they choke off credit to the economy, inducing a recession.
But when that curve finally steepens again, the profit margin for lending returns.
And that is your all-clear signal to buy banks and cyclicals.
Okay, so we have momentum, consumer sentiment, manufacturing data, and credit flow all aligning. The final step is looking under the hood of the specific sector we want to buy using the Breadth Participation Index, or BPI.
Right, BPI measures how many individual stocks within a sector are actually participating in a rally.
So if a sector index is climbing, but only, say, 20% of the stocks are driving that upward movement.
That is the footprint of quiet, targeted institutional buying. They are building positions in the highest quality names without triggering broader market alarms.
But conversely, if a sector is hitting new all-time highs and 85% of the stocks are surging,
that is pure euphoria. The smart money is actively distributing their shares to retail buyers and packing their bags.
I have to challenge this entire premise, though. We live in an era where data is totally democratized. Anyone listening to this right now can open a new tab, pull up an RG chart, check the PMI direction, and look at the yield curves today.
Yes, they absolutely can.
So if everyone has the exact same dashboard, doesn't the edge disappear entirely? Who is left to be the dumb money?
It's a highly logical pushback, but it ignores the reality of human behavior. Knowing the data exists and having the psychological fortitude to act on the data are two entirely different universes.
Theory versus practice.
Exactly. Imagine the RRG chart shows the commercial real estate sector moving firmly into the improving quadrant. But the financial news that day is wall-to-wall coverage of massive office building defaults and bank panic.
Most people simply cannot separate the visceral terror of the television narrative from the cold mathematical signal on their dashboard.
They will freeze.
They let the narrative override the numbers.
Every single time. But when an investor cultivates the discipline to trust the dashboard over the headline, they unlock the ultimate reward of the market clock, the multibagger.
Okay, let's talk about that ultimate reward. A stock that goes 10x. The source outlines a very specific three-part formula for the anatomy of these massive winners. What are the structural requirements?
The trifecta is quality, cheapness, and a massive sector tailwind. You need a business with solid underlying fundamentals that is currently mispriced due to sector-wide pessimism, sitting right at the boundary where the clock is rotating into their favor.
And structurally, we aren't looking at the trillion-dollar tech giants here, right?
No, the life-changing returns are hidden in the small and mid-cap space. You are looking for a company on the verge of massive return on equity expansion.
Give me an example.
Well, a mid-cap company jumping from an 8% ROE to an 18% ROE due to operational leverage is going to see its stock price explode much faster than a mature blue chip that has been hovering safely at 20% for a decade.
You also need to see simultaneous revenue and margin growth, meaning they are selling higher volumes and extracting more profit from every single unit sold.
Exactly.
And critically, the dashboard rules state you need low institutional ownership. We're talking around 5 to 10%.
Very low.
I want to highlight the mechanism there. If the mutual funds and pensions, the whales of the market, already own 40% of the float, the massive wave of forced buying has already happened. You need to position yourself in the stock before the whales arrive, so their algorithmic accumulation drives your portfolio up.
You want to own the asset that the massive funds are going to be forced to buy next quarter when their risk models finally flash green.
Let's anchor this with the real-world case studies the source provides from the Indian markets because they perfectly illustrate this friction between narrative and data. Take Suzlon Energy between 2020 and 2024.
Great example.
In 2020, this stock was universally despised. They had a history of brutal bond defaults. The narrative was absolutely toxic.
To the retail observer, it looked completely uninvestable. But the clock was screaming a different reality. The macro data showed the renewable energy sector was rotating rapidly from stage 2 to stage 3.
Because India was committing to a massive 500 gigawatt renewable capacity target.
Right. The sector tailwind was turning into a hurricane, and beneath the surface narrative of past defaults, Suzlon was quietly, methodically restructuring its debt and cleaning up its balance sheet.
And the result? Nearly 5,000% returns for the early believers who trusted the cycle over the stigma.
It's incredible.
Meanwhile, the retail investors who finally bought the euphoric Green Energy Revolution magazine covers in late 2024 are stuck holding dead money.
Yep. Then there's MTAR Technologies.
Oh, right.
MTAR is a textbook case of policy-driven rotation. India initiated a multi-year structural shift towards self-reliance in defense manufacturing. Early on, MTAR had incredibly low institutional ownership. It was basically off the radar.
But as the defense sector rotated into stage 4 expansion, the whales were forced to allocate capital there.
And the stock surged 107% in the first few months of 2026 alone, as that institutional capital just rushed in.
My absolute favorites are the plays on what the Aussie calls ghost sectors, like CG Power and BGR Energy.
Oh, the ghost sectors are fascinating.
These were industrial companies left for dead during a brutal multi-year bearish capital expenditure cycle. They were practically bankrupt. But when the macro capex cycle finally turned, those depressed valuations acted like a coiled spring, delivering massive triple-digit returns almost instantly.
It's all about the cycle.
So what does this all mean? Are we basically looking for the ugly duckling companies, like the garage band before they sign the major record deal? Because it sounds like if a stock is already beloved by big mutual funds, we've entirely missed the boat for life-changing wealth.
If we connect this to the bigger picture, your garage band analogy is spot on. It brings us right back to Howard Marks' foundational thesis.
Right.
Outsized returns do not come from buying a universally celebrated, flawless company at a stretched premium valuation, because perfection is already priced in.
So where do they come from?
Transformational wealth comes from buying a fundamentally sound company for drastically less than its intrinsic value, simply because it happens to sit in an ignored early cycle sector.
You are buying the temporary pessimism.
Precisely. And understanding the anatomy of these massive winners brings us to the most uncomfortable reality of investing, which you, the listener, need to confront today.
What is that uncomfortable truth?
That the specific variables that make an asset incredibly cheap and primed for a 10x run, the terrifying news headlines, the total lack of institutional support, the plunging stock chart, are the exact same variables that make human beings biologically terrified to allocate capital to it.
Being early feels exactly like being wrong.
Yes. Your peers will question your sanity. You will relentlessly second-guess your own spreadsheet.
Because the narrative hasn't caught up to the math yet.
And by the time the narrative does catch up and the financial press finally agrees with your thesis, the margin of safety is gone and the asset is incredibly expensive. The best entry points in market history remain the best entry points precisely because, in the moment, they felt like financial suicide.
Wow. So to you, the listener, we want to remind you that the clock is ticking right now, in real time, while the financial media is writing off a specific sector today as totally uninvestable. The quiet, patient, institutional money is already running the RRG charts.
They are looking at the PMI trajectories, and they are deploying capital.
They are actively severing the emotional narrative from the underlying data.
Exactly.
Which leaves us with a final provocative thought for you to explore on your own. Open up your current portfolio today. Look at your biggest winners, the stocks you love the most, the ones you brag about.
The comfort blankets.
Right. Are you holding on to them because your cold, hard dashboard data tells you they are still safely in stage 3 or stage 4 of their expansion cycle? Or are you just clinging to them because they provide a psychological comfort blanket while remaining completely blind to the terrifying, ignored stage 2 sectors where the next decade's fortunes are currently being born?
It is an incredibly difficult audit to perform on your own portfolio, but it is the only one that matters if you want to find the next multi-bagger.
Remember that blunt truth we started with. You do not need a 160 IQ to win this game. You just need the discipline to stop reading the crowd and start reading the clock. Thanks for joining us on this deep dive. Build out those dashboards, trust the cycle, and we'll catch you next time.